Hello, everybody. Luke Gromen, FFTT. Hope everybody had a great weekend. It was beautiful weather here over the last week in Cleveland in the mid 70s and lower 80s for pretty much most of the week. So felt a little bit like being in Florida usually this time of year. So we will take it. So at any rate, let me jump right in. Thank you as always for joining me. First question's from BBA. Do you think the net present value of our $200 trillion of unfunded liabilities was reduced due to the pandemic-induced inflation? I think there's a couple different puts and takes here. It made healthcare more expensive via inflation as well as with the cost of living adjustments. With that said, so that would raise the price. However, I would guess that the cost of living adjustments were probably not as high as the actual inflation, so that would reduce the net present value, all else equal. In addition, the rate hikes we've seen in the last year, just by virtue of how net present value math works, would pretty substantially reduce the net present value given the pace of hikes over the last year. I don't know by how much, but given how much they raised rates, it would be a pretty big reduction in the NPV of those obligations. And then I would also say, and it's morbid, but I think it's objective and therefore needs to be said, higher death rates amongst older Americans, and in particular the sickest older Americans, caused by the pandemic, probably over time, I would guess, would reduce the NPV as well. No measure of how much, and thus far, it hasn't shown up in the data in terms of a decline. So any case made that it has would have to be a counterfactual. In other words, you'd have to make a case that had it not happened and had those older Americans not passed away, sadly, that the costs would be even higher than they are. And I just don't know how to measure that. I've not seen anything on that. But we're not seeing declines as a result of, in terms of annual cost, rather than NPV, which is, there's a lot of ways you can play with the NPV. To me, the key number is the cash out every year. The cash out is still up pretty notably. That's the entitlement pay-goes thing I always talk about in terms of cash flow out this year. So let's see what happens. It's something I've been keeping an eye on for the last 2 years. So far, it has not showed up in declines. From TT, what are your thoughts on oil supply and demand given years of poor capital expenditures, a possible incoming recession on top of OPEC cuts? Here, too, we've got a number of different puts and takes. OPEC has been warning of secular declines in supplies due to underinvestment, some pretty drastic potential declines in global oil supplies between 2026 and 2030 if a whole bunch of money, hundreds of billions, is not spent basically to keep production where it is. Importantly, 90% of supply growth in the past 10 years have come from U.S. shale. In the last time we calculated it using the EIA's monthly productivity report, U.S. shale was declining at 6% per month. Critically, as drilling slows or stops, the pace of decline of existing shale wells will decline. So while it might be 6% per month now, that would slow. It's probably more like somewhere between 20 and 30% decline rates on an annualized basis if you stopped all shale drilling. So this is where the puts and takes comes in. Short term, obviously there have been recession concerns about oil and oil prices. With that said, the worst recession annual declines in global oil consumption in the past 45 years was a 4% annual demand decline in 1980 and a 9% annual decline year over year in 2020 when obviously the global economy was all but shut down. So if we have shale, 90% of global supply growth over the last 10 years declining at 6% per month roughly, if drilling stopped for at least several months, as I said, that rate of decline would decline with each passing month, you could see 90% of supply growth down 20 to 30% annually, easily. OPEC cuts are further supportive of oil prices. And so my point here is that it seems to me the weighting of a recession on oil prices is probably overcooked relative to the supply side response that would likely come from shale, that obviously being supported by OPEC. Basically, my where I shake out on it is I'd be very surprised if we get another huge decline in oil prices, even in a recession, given these supply side dynamics. I think to get a huge decline, you basically need another global shutdown, because you're just looking at rates of supply side decline of some important parts of the supply base that vastly outstrip basically anything other than a global shutdown. So let's watch. From Alex, are there any books or essays you recommend on the history of reserve currencies, or the pound in particular, and how it lost its status? One that I think is a must-read for everybody, and I've said this many times, is Lords of Finance by Liaquat Ahmed. It's a biopic on the central bankers of the UK, US, Germany, and France from, call it 1918 through 1939, give or take. It reads, I read it first time in I think 2010, and it has been just an indispensable guide. Yes, times change. Yes, technology changes. Human nature never changes. And so it is just so useful to see the challenges these central bankers faced, how similar they are to the ones our central bankers have faced really since the great financial crisis, and how similar their responses have been. It ends up being very useful from a predictive standpoint. From PJ, please expand on ratio of gold versus silver for precious metals allocation and preferred denomination and type of each, i.e. 1 ounce of gold versus 1/10 ounce, 10 ounce silver bar for 1 ounce versus 1 ounce coin, sovereign issued versus exchange stamped. I prefer 1 ounce sovereign gold coins. Smaller denominations, certainly if they make sense, then by all means. They do carry higher premiums, notably higher premiums typically, and so for me, you end up paying more for the same underlying ounce of gold, which I just don't like to do and don't recommend. I prefer gold to silver overall in a precious metals allocation. I think silver will do well. With that said, it is more of an industrial metal, obviously has more cyclicality to it in that way. But critically, only gold is on central bank balance sheets. Central banks do not hold silver. And that suggests to me that gold is the only metal of the two that can be written up to recapitalize central bank balance sheets whenever that needs to eventually happen. And so I do own some silver. I prefer coins there too, the 1 ounce coins, sovereign coins, just for ease of use and resale. With that said, they do tend to carry, at least lately, very high premiums. I don't know if that is a minting issue because the premiums don't seem as high on bars, but those are just those premiums on the 1 ounce sovereign gold or silver coins have been too rich for my blood at the moment. So there may be some dealers out there that don't have those premiums, and I would look into sourcing it from them if that's your preference. Let's see. Hi Luke. Recently saw some tweets regarding the dwindling of the TGA and the need of a Hail Mary in tax receipts. What do you think would be the Fed's move in interest rates if receipts are low and the debt ceiling approaches faster? In my opinion, the Fed's unspoken third mandate was shown to remain in effect last month with the BTFP, swap lines, etc., which is the unspoken mandate is Treasury market functioning. They will not stand aside when the Treasury market dysfunction gets too great. And so if we get a situation where tax receipts come in worse than expected, which is my base case, the debt ceiling would then hit sooner than expected, which is probably also, I guess, my base case. In my opinion, all else equal, those two factors would serve to increase Treasury market dysfunction, Treasury market volatility, which has come down pretty meaningfully over the last 2 weeks, given these liquidity injections. So my base case is the Fed has shown their hand. They are who we thought they were, as Dennis Green famously said. They are going to manage Treasury liquidity to make sure there isn't dysfunction. And quicker debt ceiling, worse tax receipts will heighten, in my view, Treasury dysfunction, all else equal, which I think will draw the Fed back in liquidity as needed. Don't know what that means for rates, but I do think it means liquidity will be provided as needed if needed, which for our purposes is probably all we need to know. From BB, why did the Fed create positive real rates, Luke? You thought for many years negative real rates was the only solution, like post-World War II. Does the Fed have another purpose? I don't know. There was another question regarding thoughts about Tom Luongo's thoughts on terms of the Fed and maybe some others acting in the interest of trying to prevent some wars, etc. I don't know. I don't know if it was desperation, if it was dogma, if there's something else going on. I think it might just be a case. The Occam's razor explanation is simply they saw risk to their credibility with inflation, and with high inflation, sort of everything that they've strung together over the last, in terms of how the system works, all of it was based on the assumption that inflation would never return. And so I think it's more just desperation to get inflation back down. With that said, the inflation that they are so desperate to get back down was the only thing keeping the U.S. fiscal situation from going completely pear-shaped. It was the only thing keeping the U.S. government solvent. And by solvent, I mean keeping U.S. government receipts above true interest expense of entitlement paygoes plus Treasury spending. So they're now getting upside down on that metric where if they're not there yet, they will soon be, in my analysis, back in a position, the U.S. government will be back in a position where Treasury receipts are not covering true interest expense on an annualized basis. That is very dollar positive because it creates a dollar squeeze, but it's also very Treasury market volatility positive. And remember what we just said, the Fed's unspoken third mandate is to make sure the Treasury market functions properly. So ultimately, this dynamic that the only thing keeping the U.S. government solvent was the inflation, the very same inflation the Fed has been doggedly fighting for the last year, I don't get the sense it's very well understood by consensus at the moment. I think consensus is going to understand this in the next couple of months based on events. As they do, and as they understand, either the Fed finances the difference or we get more of the 2022 dollar up, everything else down, Treasury market dysfunction regime, or they probably skip right to the part of the movie where they just assume the Fed's going to come back in with more liquidity to keep Treasury market keep Treasury market liquidity high and volatility within a manageable range, as we saw the Fed do last month. From Chris, I would be very curious to hear your thoughts on the U.S. Brazilian real cross rate and where you think it might be going over the next year, next 3 years, and why, specifically in regards to the latest Lula visit with China, perhaps reflexively what that says about the dollar. So there's as I think about the question, it's a great question. I think about it in two dynamics as it relates to FX, relative FX rates. There's two key components. There is relative interest rates, which has really been the only thing that's sort of mattered for relative interest rates by and large over the last couple/several decades. And basically, in plain English, will Brazil out-hawk the Fed or will the Brazilian central bank not? Gun to my head, they probably won't. They historically haven't. They probably won't. I'm not that well versed in where their fiscal situation is, the Brazilian fiscal situation is. So I don't have a strong feeling on will the Brazilian central bank out-hawk the Fed over the next year. Probably not. With that said, that brings us to the second component of relative FX valuation and how little that is being discussed. And this ties into the Lula China visit, which is to say there's a second component to relative FX valuations, and that is balance of payments and capital flows. Most market participants have not had to think about this vis-a-vis emerging markets in a long time, but this is where this China-Brazil direct trade dynamic starts to get really, really interesting. Non-dollar settlement of Brazilian commodities would start to give Brazil a lot greater leverage potentially in managing their own domestic dollar liquidity. So if we think about this, Ghana came out and said we're going to use gold for oil, right? And it's not exactly the same problem as Brazil. Brazil's a net exporter of commodities. But in the 4 months since Ghana said we've begun using gold for oil, Ghana's inflation rate has gone from 155% to 63%. Massive declines in inflation. Still elevated, but massive sequential declines. Inflation has basically collapsed. As a friend of mine said, gold works, right? Gold works. So the point here is that if Brazil, as we look out over the next 3 years, if Brazil is actually really successful in moving to more yuan trade direct, they can accept yuan for commodities in increasing amounts, use those yuan to buy Chinese goods, settle some of those goods with in net gold settlement potentially frees up dollar liquidity that Brazil can then use to manage the Brazil real or the Brazilian real dollar cross rate in a way more advantageously to Brazil. And at any rate, it suggests that Brazil might be getting a third lever that right now China has, Brazil doesn't, which is instead of either raising rates to defend the Brazilian real or burning down FX reserves, selling dollars to defend the Brazilian real, they could start changing the percentage of trade done in dollars, save their dollars for elsewhere. It starts to open up a third lever for Brazil to manage its cross rate against the dollar. And so next year, I don't know. Will they out-hawk the Fed? Probably not. They've not had a good track record on that front. The next 3 years, I think there's whatever the market chance is in terms of where they think the real is going to be over the next 3 years, I think it'll be stronger than expected versus the dollar. Based on the de-dollarization of their trade with China, which is like a third of their trade, freeing up dollar supplies to allow them a third lever to manage the Brazil dollar cross rate. So long way of background, but I think it's important. Hopefully that helps. And then the final question from SH, what are the best measures of liquidity that have the most meaningful correlations, positive or negative, to the S&P 500 performance? Where can they be found? The one I've seen that I think is it's sort of a Texas hedge. It's not perfect, but I think it's helpful. Has been the Fed balance sheet minus reverse repo balance minus Treasury general account, and that gives you a sense for where liquidity, broad dollar liquidity, has been moving in this regime. It is not perfect. You have to also consider what is happening to the relative dollar level. As the dollar strengthens against other currencies globally, that reduces global liquidity, all else equal, in a way that is difficult to measure because there's a lot of foreign debt denominated in dollars. So basically, as the dollar goes up, dollar debt grabs a greater amount of liquidity of the world. Similarly, if the dollar falls, that adds to liquidity, again, in a difficult to measure way. But it basically increases the amount of global liquidity as dollar debt service consumes a smaller portion of global income statement, if you will. And then oil has kind of the same dynamic. Higher oil, all else equal, restricts dollar liquidity, and lower oil increases it. With, again, that is changing as countries start being able to buy oil outside the dollar, including China, the biggest oil importer in the world. That dynamic is a little more fluid, but that at least I think helps give a framework for metrics you can watch and plug in, and you can find the Fed balance sheet, the reverse repo balance, and the TGA balance in the Fred website. So you can check those out online. You can construct that index yourself. I have. So with that, I'm going to finish up for the night. I want to thank everybody for joining me. As always, if you like these updates, check out FFTT-treerings.com. 10 most interesting things. Quick synopsis on what grabbed our attention about them, whether they are supporting or refuting a way about which we had previously been thinking about the world or that particular facet of the world. So thank you very much for joining me. Everybody have a great week. We'll talk to you soon. Take care.